Budgeting is a fundamental aspect of personal finance that involves creating a plan for how you will spend and save your money. It helps you track your income and expenses, prioritize your financial goals, and ensure that you are living within your means. To create a budget, you first need to determine your total monthly income and list all of your expenses, including fixed costs like rent and utilities, variable costs like groceries and entertainment, and savings goals like retirement or emergency funds. There are several different types of bank accounts that serve different purposes. A checking account is typically used for everyday transactions, such as paying bills and making purchases, while a savings account is designed for storing money that you want to keep safe and earn interest on. Other types of accounts include money market accounts, certificates of deposit, CDs, and retirement accounts like IRAs and 401ks. Interest rates play a crucial role in personal finance, as they determine how much you will pay to borrow money or earn on your savings. When you borrow money, you are charged interest, which is a percentage of the total amount borrowed. On the other hand, when you save money in an interest-bearing account, you earn interest on your balance. The higher the interest rate, the more you will pay or earn over time. Credit cards and debit cards are both payment methods that allow you to make purchases without using cash. However, they work differently in terms of how the money is accessed and the impact on your finances. A credit card allows you to borrow money from the card issuer up to a certain limit, which you must repay with interest. A debit card, on the other hand, deducts funds directly from your checking account when you make a purchase. Building and maintaining a good credit score is essential for accessing credit at favorable terms and rates. To improve your credit score, you should pay your bills on time, keep your credit card balances low, avoid opening too many new accounts, and monitor your credit report regularly for errors. A good credit score can help you qualify for loans, credit cards, and other financial products, as well as lower your insurance premiums and security deposits. An emergency fund is a savings account that is specifically set aside to cover unexpected expenses or financial emergencies, such as medical bills, car repairs, or job loss. Financial experts recommend saving 3 to 6 months' worth of living expenses in an emergency fund to provide a financial cushion in times of need. Having an emergency fund can help you avoid going into debt or dipping into your long-term savings when unexpected expenses arise. Loans are a form of borrowing money that must be repaid with interest over time. Before taking out a loan, you should consider factors such as the interest rate, loan term, monthly payments, and total cost of borrowing. You should also evaluate your ability to repay the loan based on your income and expenses, as well as the impact on your credit score and financial goals. Insurance is a financial product that provides protection against specific risks such as illness, injury, property damage, or loss of income. Common types of insurance include health insurance, auto insurance, homeowners or renters insurance, life insurance, and disability insurance. Insurance helps you manage risk and protect your assets and financial well-being in case of unexpected events. Taxes are mandatory payments that individuals and businesses are required to pay to the government to fund public services and programs. Taxes are based on your income, assets, and transactions, and are calculated using a specific tax rate or formula. When filing taxes, you must report your income, deductions, credits, and other financial information to determine your tax liability or refund. It is important to understand how taxes work and comply with tax laws to avoid penalties or legal issues. Compound interest is a powerful financial concept that allows your money to grow exponentially over time. It is the interest earned on both the initial principal and the accumulated interest from previous periods. Compound interest can work for you when saving or investing money, as it allows your balance to grow faster than simple interest. By taking advantage of compound interest, you can maximize your returns and build wealth over the long term.